Oil just dropped 8% in a single day. That is the largest single-day oil price decline since the Strait of Hormuz crisis began on February 28th. And the reason is a development Signal Markets has been telling you to watch for since our very first oil video. Reports that the United States and Iran are nearing a deal that could reopen the world's most critical oil choke point. But here is what the headlines are not telling you. Even if a deal is signed tomorrow, the oil crisis does not end tomorrow. The mine clearance problem, the insurance problem, the shipping normalization problem, they do not disappear with a ceasefire announcement. And the structural damage done to global energy markets over the past 2 months has permanently changed the floor price for oil. In the next 11 minutes, Signal Markets breaks down exactly what is happening, what a deal actually means for oil prices, gold, crypto, and your portfolio, and the specific signal that tells you when the market has truly turned. Stay to the end. Before we go further, nothing in this video is financial advice. Signal Markets is an educational channel. We analyze publicly available data and research to help you understand how markets work. Always do your own research and speak to a qualified advisor before making any investment decisions. Here is the situation as of today, May 6th, 2026. Iran has submitted a 30-day roadmap to the United States via Pakistani mediators. The plan involves 3 phases. Phase 1, de-escalation. Iran reopens the Strait of Hormuz, and the U.S. lifts its blockade on Iranian ports. Phase 2, a nuclear freeze. Iran limits uranium enrichment for up to 15 years. Phase 3, broader nuclear negotiations. According to Axios, U.S. officials believe a preliminary agreement could soon be reached, outlining a framework for broader nuclear talks. President Trump has signaled that a deal could reopen the Strait of Hormuz, but warned of more intense strikes if Iran fails to comply. Trump also temporarily halted Project Freedom, the U.S. military operation launched just days ago to escort commercial vessels through the strait, citing progress in negotiations. Markets reacted immediately. Brent crude dropped more than 8% to below $101 per barrel. WTI dropped more than 9% to below $93. These are the largest single-day declines since the crisis began. But here is the critical question. Does an 8% drop in oil prices mean the crisis is over? The answer is no. And here is why. A ceasefire announcement and a physical reopening of the Strait of Hormuz are 2 completely different things. The market is currently pricing in the announcement. It is not yet priced in the reality of what reopening actually involves. Problem 1, the mines. Iran laid sea mines throughout the Strait of Hormuz when the conflict began. Some of those mines were subsequently lost. Their exact locations are not fully known even to Iran. The United States has said mine clearance will take approximately 6 months even after a ceasefire. Trump has ordered minesweepers to triple their activity. But physics and maritime engineering cannot be accelerated by executive order. Mine clearance is slow, methodical, and dangerous work. Problem 2. Shipping insurance. Major shipping companies, including Maersk, CMA, CGM, and Hapag-Lloyd, suspended all strait transits at the start of the conflict. They will not return until war risk insurance is reinstated at commercially viable rates. That insurance will not be reinstated until insurers are confident the waterway is physically safe, not just politically declared safe. Problem 3. Normalization takes weeks to months. Even after the strait is declared open and insurance reinstated, vessels need to be repositioned, cargo schedules rebuilt, supply chains restarted. A full recovery in shipping and trade flows is expected to take several weeks at minimum, even after a deal. Problem 4. The new floor price. Analysts now expect $80 to $90 per barrel to be the new structural floor for oil regardless of the deal outcome. The crisis has permanently repriced energy risk, war risk premiums, strategic reserve rebuilding costs, and infrastructure investment requirements all support a higher baseline oil price than pre-crisis levels. Brent at $101 after an 8% drop is still 35% above where it was a year ago. Let's connect this directly to your portfolio because a potential deal changes the picture differently for different assets. For oil, the 8% drop today reflects deal optimism being priced in. If a deal is confirmed, expect further near-term pressure, potentially toward $90 to $95 per barrel for Brent as the market prices in eventual supply normalization. but $80 to $90 is the new floor, according to most analyst forecasts. Oil is not going back to $75, even with a full resolution. The structural damage is done. For energy equities, short-term pressure as oil price falls reduces revenue expectations for oil majors. But at $80 to $90 oil, Exxon, Mobil, Chevron, Shell, BP, and Total Energies are still generating strong cash flows. A controlled decline in oil prices from crisis levels is not a disaster for energy stocks. It is a normalization. Energy sector ETFs remain a valid position in an $80 to $90 oil world. For gold, this is the most nuanced picture. Gold rallied on the geopolitical crisis. A genuine peace deal removes part of the safe haven bid. Expect some gold price pressure if a credible deal is signed. However, the broader macro case for gold remains intact. Inflation is still above target. The Fed still cannot cut rates. The structural petrodollar questions we covered in Video 6 have not been resolved. Gold may pull back on deal news, but the fundamental floor remains solid. For crypto, Bitcoin has been tracking equities closely throughout this crisis. If a deal sends stocks higher on relief, crypto likely follows in the short term, but the deal removes the geopolitical fear premium from markets broadly. Watch the correlation with the S&P 500. If it stays above 0.8, crypto is still just a risk asset following equities. For bonds and rates, a deal that lowers oil prices reduces inflation pressure. That gives the Fed more room to consider rate cuts later in 2026. Watch the 10-year Treasury yield. If it falls below 4.2% on deal news, markets are pricing in Fed rate cuts returning to the agenda. For consumers, the most direct positive impact. If oil falls from $110 to $90 per barrel, petrol prices follow within 2 to 4 weeks. Grocery prices take longer. Food price relief is 6 to 8 weeks behind the oil price. Lower oil is unambiguously good for every household's cost of living. Here are the genuine risks that could prevent or delay a deal. Risk 1. Iran's internal politics. The death of Supreme Leader Khamenei in the February strikes created a power vacuum. The new leadership needs to demonstrate strength domestically. Accepting U.S. terms too quickly could be seen as capitulation. The hardline Revolutionary Guard may resist any deal that appears to reward the U.S. attack. Risk 2. The mine problem is not solved by a deal. Even if political agreement is reached, the physical safety of the strait remains uncertain until mines are cleared. Shipping companies will not return regardless of political announcements. Risk 3. The nuclear freeze terms. Iran agreeing to limit uranium enrichment for 15 years is a significant concession. Israeli opposition to any deal that leaves Iranian nuclear infrastructure intact could complicate negotiations. Risk 4. Trump's unpredictability. The same president who dismissed warnings about Iran closing the strait before the February strikes could shift position rapidly. Markets have learned that Trump's statements do not always translate into stable policy. At the start of this video, I promised you the signal that tells you when the market has truly turned. Here it is. Watch 3 numbers over the next 30 days. Signal 1, tanker count at marinetraffic.com. Watch for sustained daily transits above 30 vessels. Physical confirmation the deal is holding. Signal 2, war risk insurance reinstatement. When Maersk or Hapag-Lloyd announces resumption without military escort, that means professional risk assessors have concluded the waterway is safe. It will move oil markets more than any political statement. Signal 3, Brent crude holding below $95 for 5 consecutive trading days. That confirms supply normalization is beginning, not just a temporary relief rally. All 3 together, tanker count above 30, major shipping resumption, Brent below 95 for 5 days. That is your confirmation the crisis is genuinely resolving. Until all 3 are confirmed, treat deal announcements as optimism to be verified, not conclusions to act on. To summarize, oil dropped 8% today on Iran deal reports. A deal and a physical reopening are completely different things. Mine clearance takes 6 months. Insurance requires physical safety. The new oil price floor is $80 to $90 regardless. Winners if deal holds. Consumers bonds, crypto short term. Energy stocks remain viable at $80 to $90 oil. Gold pulls back but fundamental floor intact. The 3 signals. tanker count above 30, major shipper resumption, Brent below 95 for 5 days. When all three confirm, the crisis is entering resolution. Until then, verify before acting. This is Signal Markets. Find the signal. Ignore the noise. Link in description below. Do your own research. Nothing here is financial advice.